And now let's welcome in to have more conversation about where this market could be heading. Stephanie Link, a CNBC contributor, of course, also of Hightower, and Dan Greenhouse of Solus Asset Management. It's good to have you both with us. So, Steph, I said, coming in today, critical levels, 200-day moving average on the S&P. Got a little bit of a move higher here as we begin the final stretch, but also that 10-year above 4%. And then you have the overlay of the technicians and what they're watching in the real critical levels to suggest whether we really are going to have more downside or not.
Yeah, I mean, I think today we have a little bit of Dan Loeb effect, right? Because he is very bright and he has a great track record. And for him to get aggressive on a name that he sees there's a lot of opportunity, especially in the second half, especially after NVIDIA, and we're going to talk about semis later. But I think that's a vote of confidence that there are places in the market that you can invest in. It's not overall the broader market, right, that you want to be invested in this year. You want to be a stock picker. And you mentioned that the market is expensive at about 18 times forward, but there's so many stocks out there, Scott, that are not that expensive. In the meantime, the broader averages, I think, were in a trading range. We've talked about this endlessly, and I thought it was sort of interesting today that everyone now expects, after the unit labor cost number came out and inflation continues to be persistent, everyone's talking about, okay, more rate hikes this year and then all of a sudden more rate cuts next year. They're nowhere close to cutting. That's not even in the vicinity of their thinking at this point.
Yeah, that's for sure.
We are all data dependent, and the inflation numbers, no matter which numbers you're looking at, CPI, PPI, core PCE, services ex housing, it's still too high and too hot. And so that's why you're going to continue to have the Fed being very hawkish. And so I think it's very premature to start thinking about and starting to bet on a Fed reversing next year.
Bostic today, still in the 25 basis point camp. He says there's a case to be made that we need to go higher. We're going to see. You're going to get Dan Greenhouse jobs report a week from tomorrow. You got CPI not that far away. You got the ultimate Fed meeting coming in play, too. So how do you see it right now?
I mean, listen, it's as difficult today as it was a week ago, as it was a month ago. There are so many different cross currents, and Steph makes a good point about the market pricing and rate cuts. I don't know why anyone's even thinking about rate cuts when we're still not sure what the ultimate path for the rate hiking cycle is going to be. At this point, you're certain to see a rate hike later this year. You're certain to see a rate hike after that. At this point, you're probably talking about July as well, which is going to take the Fed funds rate up close to 5.75.
Well, see, that's a little bit further down the road than the market is willing to accept at the current time. We figure, okay, you get 25 basis points in March, you get another in May, you get another June, and then maybe you're done. You're even thinking about going higher than the market thinks right now.
Well, listen, if there's one thing we can say for sure, it's that just about everybody's been wrong about this entire conversation for the better part of a year or a year and a half. When you look back at the stuff that everybody has said and done, it's all basically fluff in retrospect. It has no weight at all because the reality on the ground proved everybody incorrect. And so I think at this point, with the stickiness of the broader levels of inflation that Steph alluded to, the confidence interval that we should have around where we think this is going to settle out, I think should be wider than normal and even wider than it was a month ago. It's proving to be very, very difficult.
So, Steph, I want you to tell me what I'm supposed to do with the fact that earnings estimates continue to come down. Margins are coming down, the bread and butter of how you look at stocks, right? You always talk about margins. So if margins are declining and earnings estimates are coming down at the same time as a result, but interest rates are moving up and at the very minimum staying a little sticky where they are, how do you make a positive case for stocks in that environment?
I think there are certain sectors and certain stocks, Scott, that margins are actually holding up well because they have pricing power. We talk about this all the time. We're going to talk about a stock in the next block about that very fast, right? I'm teasing. I know how to do this, I think, at this point.
All right.
But no, my point being is in industrials, in materials, even in energy, there's so much pricing power. And even within energy, these services businesses, they are absolutely minting money. Numbers are going much, much higher in that sector. And that's an out-of-favor sector at this point. But I could pick a bunch of stocks within that sector that I like very much. I'm overweight industrials. You know that. Materials, as I mentioned, they have pricing power. Look at Cleveland Cliffs, the fourth price increase today.
Yeah, Jim Leventhal was talking about that very one. Of course, he owns it, and he mentioned that on halftime as well.
And I will just say this, on retail, I actually feel better about retail. If you look at the inventory numbers, they've been coming down year over year and sequentially across the group. That actually does bode well for margins in the second half of the year.
Right.